And that's why if we just zoom in and look to the right of this wick, that's why we do get a small reaction, but then an eventual fail in price action. And now we can move on to this supply zone. Again, sweep of liquidity, break of structure, valid supply zone. We also have a mitigation of a previous supply zone, therefore higher probability supply zone being formed. And then we move on to this one. Again, we said we don't really have a sweep of liquidity. We really just have a break of structure, and we have inducement below. This one, we have sweep of liquidity, break of structure, mitigation of a previous demand zone, which is why this wick is a very valid demand zone to look for buys. And then one other thing that we'll just go over is a little bit more recent price action right here. And what we can see is when we're looking at a change of character, we're tapping into a higher time frame demand zone. So we know that the likelihood of price potentially looking for a reaction to look for buys and maybe even reversing trends to start putting in higher highs and higher lows on, say, a 15-minute and 4-hour chart start to increase. So now we're just looking for reasons to look for entry. So these red lines are our change of character on a 15-minute. But what we can see here on the 1-minute chart is as price comes to continue down, we react off of a demand zone. This demand zone sweeps liquidity. It breaks structure. We see that price does get respected. We get another tap into it. If we're looking at this as a demand zone, has it broken structure? No. Has it swept liquidity? Arguably, no. Has it mitigated something? Yes. Therefore, it is valid. But then what we can see is when we react off of it, we get a slight reaction. What are we dropping? We're dropping equal lows. What is likely to happen? We're going to break to the downside. We also see these structural highs. So chances are internal range liquidity for future use. And then what we can see is we break to the downside. Then we start to move to the upside. We get a reaction to the upside. Have we broken any structure? No. Have we swept liquidity? Yes. Therefore, valid POI. Would you look to trade that? Probably not. That's pretty aggressive to look for a trade there, but we're starting to use that as a basis. Now what we can see is this point right here. Did we break structure? Yes. Did we sweep liquidity? Barely, but yes, we did. And have we mitigated something? Yes, we have. Okay, now we're starting to see valid, very valid points of interest, demand zones taking place. We're starting to tap into, again, a higher time frame point of interest. Now we can see this point of interest, whether we use the inside bar or the inside bar plus the wick or just the wick. If we're using the wick, we can see that the wick doesn't get respected. When we're on the 1 minute, I tend to include the inside bar plus the wick just for consistency purposes. I mean, at the end of the day, the zone itself is only about 2 pips, so it's not the end of the world. But what we can see is, do we break structure? Yes. Do we sweep liquidity? No. Do we mitigate something to the left? Yes, we do. Okay, valid point of interest. Move on to the next point of interest. We can see, do we break structure? Not really. Yes, this inside bar is indicative of a range on a lower time frame, and more than likely on a seconds time frame that would be a break of structure. So yes, we could argue it is a break of structure. Is it a clear 1 minute break of structure? No. Does it take liquidity? Not really. Yes, we have some lows here again on the seconds chart. We could classify those, but we're looking at 1 minute structure. Does it take liquidity? Not in a formal sense. Does it mitigate something? Yes, it does. Therefore, valid point of interest. And we continue on looking at this. We have a push to the upside. Do we break structure? No. Do we take liquidity? No. Do we mitigate something? Yes, valid. And then we continue on. We can see that we have this wick now. Do we break structure? Kind of. Again, this is lower time frame structure, but we're starting to wick structure. We're taking out the liquidity of this. Have we taken liquidity? No. Have we mitigated something? Yes. Therefore, it is valid, and we can continue that process. But again, this is why we stack our probabilities in our favor, because what we can see is in this instance, yes, we did mitigate something. Yes, we kind of broke structure. Does that sound like we should be taking a trade? No. But what it is framing our minds up from a logical perspective is we're starting to see order flow taking over. We're starting to see respecting of demand zones and price continuing. But on the flip side, what is that also showing us? Price hasn't really moved. We haven't really seen a huge move to the upside. When we're starting to see demand zones getting respected and that process of mitigation taking place, we should start to see large moves to the upside. And what we can see is if we just scrunch the chart to the upside, we do consolidate for a while. But what we can see is we have a demand zone here. If we look here, again, we tap into it. We've broken structure. We can see that we've actually broken true structure. All of this is more minor structure until we break swing structure on the 15-minute. That's our true change of character on the 15-minute. We tap in. So we have a mitigation. We break structure. Do we take liquidity? No, we don't. But that's okay. Then we can look at this bit. we take liquidity, we break structure, we create a valid point of interest. Yes, we've mitigated something to the left. Can we use that as a valid point of interest? Yes, we can. We can see it does wick lower about 0.7 pips. So whether we stay in that trade is a whole different story. But again, valid point of interest. And we can just keep going and looking at this process. But the biggest and most important thing to understand is using these probability increasers for supply and demand zones, breaks of structure, sweeps of liquidity, mitigations. If we can combine all three, we can create high probability trade ideas. We don't necessarily need all three. And again, like I said, you'll see that breaks of structure and sweeps of liquidity are a lot more common than mitigation. And one thing we need to factor in as well with mitigation is sometimes when we get too many mitigations, we start to create structural liquidity. So we need to be careful. But if we start to see large moves away from that, then what we can assume is that process of mitigation was an accumulation of orders to then start changing momentum. And again, when we've seen this where we took out liquidity, we broke structure, we mitigated something to the left, this is a valid point of interest. And what we can see is we do get a proper respect of it. But then what we can see is the tap into it creates more internal range liquidity in the form of equal lows. Therefore, sell side liquidity is more than likely resting below these. And what do we end up getting? We get a sweep of that liquidity, break of structure. We tap into that. Yes, we could argue that this is just mitigating this area as well, but more importantly, we sweep liquidity, we break structure. And it gives us an opportunity to use this as a future point of interest. We haven't actually seen anything happen with this point of interest, but then what we can start to see is we break structure. We can start to look at these areas, and then we can see price run off to the upside eventually when the momentum takes over. But it's looking at that sort of price action and understanding what's going on behind the scenes, how price is interacting with supply and demand, how we're interacting with liquidity, how we're interacting with market structure, things like that to build high probability trade ideas. It's all about reading all of the clues, looking at information. If you're looking at a trade and you're like, well, it's kind of mitigated, well, it kind of broke structure, well, it kind of took liquidity. If you're not certain about it, just don't take the trade. Use it as a probability increaser for your next trade, because if you get a kind of break of structure, a kind of mitigation, and a kind of sweep of liquidity, but you're not sure whether you'd enter it, don't enter it. Wait for price to return to that area. Say, okay, is price going to respect it or not? If price does respect it and say we get a true break of structure, a true sweep of liquidity, and a true mitigation, or the combination of two of those or just one, then you can start to say, well, I know that we're seeing the process of demand being respected, for example, and that first zone was a little iffy for me. I didn't have that warm fuzzy feeling, but now that I'm seeing all of these factors playing into the next zone, that gives me more of an indication that price will respect that zone. But again, we are factoring in the higher time frame market structure. We're understanding the concept of internal versus external range liquidity and supply and demand to combine all of these into a convenient package to understand what's happening behind the charts. Because if we don't understand market structure, we can't understand trend. And if we don't understand trend, we don't understand the direction. If we don't understand supply and demand, we don't understand the concept of fair exchange or buying and selling, which is causing the imbalance in the markets where large orders are being placed. And if we don't understand liquidity, we don't fully understand where pockets of orders are resting within the market. And if we don't understand that, we don't have a strong indication of where price is likely to move before we see true moves when we're balancing the order book. And if we don't put all of these concepts together, we can't frame up high probability trade ideas that go in the direction of the higher time frame. We're not putting ourselves in the best position for looking for entries. We're not being targeted as liquidity because we're entering too early. So what I would recommend for all of you to do that are watching this video now is, again, go back to your charts, look at mitigations, look at price returning back to supplier demand zones and creating new supplier demand zones and seeing the power of that, whether it's for actually taking trades or just starting to build confluence for order flow to be built. Because as I said, when we were looking at this little bit of information, we were starting to see a change of character before we got the change of character on the 15-minute chart, but we were able to understand what was happening on a 1-minute time frame. We were able to see the order flow switching from bearish to bullish. And while some of these points of interest were super aggressive and didn't have a lot of confluence, as we start to see them building up, it gives us more probability to start looking for trades. So if we didn't take this one, That's okay, because we didn't really have any indication. If we didn't take this one, because again, we didn't have a whole lot of indication, that's okay. If we didn't take this one because we didn't have a whole lot of indication, that's okay. We start to see our 15-minute change of character. We're starting to see impulsive nature into the chart. Then we can start to build trade ideas within this bit of price action, because now we're starting to see that picture come alive. We don't have to be the first into any trade. We can just stack probability in our favor and make the most informed trading decisions, because at the end of the day, that's what trading is all about. It's about being smart. It's about putting as many factors in your hand as you possibly can so that you can make informed trading decisions that ultimately make you percentage, that make you or make you money. So again, just hit your charts, start studying this stuff. Again, if you're the concepts of internal versus external range liquidity or structure, or even just basic supply and demand zones are still a little bit fuzzy as we've gone through all of this. I'm trying to build on everything into a convenient package as we continue. And as we're building on, I'm trying to add everything in so that you can see that they all do work in hand. So if there's an area you don't understand, I strongly encourage you going back to the previous videos, studying them so that you can understand, because everything just continues to build on from here as we continue on.